In this section, we'll be looking at another core area of trading development which many of you might be aware of without fully internalising it. This, of course, is risk management. Without risk management, all of the other pillars become compromised and ultimately useless because everything can collapse in on itself by lacking professional money management skills. The statistic that very often gets taught across trading floors throughout the city is that if 100 traders were given the exact same strategy and that strategy had 60% winning odds percentage, only 5 of those traders will be in profit by the end of the year. Let's just think about this for a minute. In spite of 60% winning odds, 95% of traders will lose money. That means that out of an average class size here every 2 months, only 1 trader will make it and achieve their dream of creating their trading business. And the main reason? Their poor risk management skills. Risk management is the most significant part of any successful trading system, and almost all traders do not realise just how important it is. Risk management isn't an innate ability bestowed at birth on only the luckiest individuals. It is a choice, and it's a choice that we can all make when building our business. The purpose of this section is to give you the grounding in how to successfully build a risk management strategy for yourself, and of course, we'll focus much more on this during the main training program. This education will allow you to have the foundation from which to build your entire trading business plan. Right at the beginning of this plan, we need to focus on what your goal is as a trader. Your goal is to create your very own business, and that business is trading the markets for a profit. The money you make from that may come from various sources, such as trading your own capital, managing the money of others, or consulting to other trading firms in some context. But the overall goal is that business, and at the very heart of it will be your ability to profit consistently from the markets. So let's look at the reality of having a trading business. First of all, we'll look at the incomes that trading will provide. The starting point will be to determine what you need in order to live. Just like any business, you will need to take out as little as possible from your new business in the beginning. And this will most likely be in the form of your minimum salary. Once you've identified this, you can then develop this into a target or a process goal that we can focus on each day. This can be a daily target or a weekly target or a monthly target. This will give you a very real process goal to focus on and help with the development of your trading psychology at the same time. Next, you need to factor in your fixed costs of doing business. These can include your desk fee or cost of equipment. This is similar to the rent you have to pay in a traditional business. Once you have these costs, you can then factor this into your targets and process goals. Finally, we have the variable costs of your trading. These include things like the cost of trading, such as brokerage fees, commissions, etc. Your trading losses can also be factored into this. Now, as a trader, you must focus on these costs because you have control over them. For example, you can minimize your losses through operating in your best emotional state. You can reduce the leverage you are using on each trade and focus on managing your trades better. Once you've mapped this baseline out for your trading business, you're then ready to start building your trading strategy, develop your trading mentality, and of course, integrate your personal money management rules. But the most important thing to bear in mind here is that your risk management skills will be the key aspect of your trading, which in turn will determine whether or not all of your goals and targets are met. Okay, so obviously we've created all these other sections to give you the training you need in order to analyse the markets and trade effectively, and this is the main purpose of the other 3 pillars. So what we're going to focus on now is the creating of your risk management plan from the very beginning. So, when doing this, it's worth considering the following questions. Okay, so when will you trade? When will you avoid trading? How will you enter and exit your trades? How much of your account will you risk on each trade? Remember, as we touched on earlier, a big part of risk management is deciding how you will allocate and control your resources. You must plan and set risk management criteria from the very start, not as you go along. Let's look at each of these points one by one to determine how to actually create your plan. So, first of all, when will you trade? This is important because sometimes a day actually increases your chances of making a profit. An example of this is if a central bank unexpectedly cuts their interest rate. Okay? Now, one key rule of trading is that the more unexpected the event, the more of a reaction the market will give and the more profit potential is in the trade. The market will react violently to this information, and very often this is the exact type of opportunity that allows us to enter the market and make a profit in a relatively risk-free manner. However, if you are not at your desk during the times of these types of news releases, then you're actively missing out on the possibility of making lower risk profits, which violates the principles of risk management because our goal is to achieve our targets with the lowest risk possible. These type of events are usually scheduled in advance, so one very good time to trade would be when economic events, central bank press conferences and speeches are planned throughout the day. Of course, not all of these events will provide tradable opportunities, but in order to catch the ones that do, you should be active at these times. Now, there are other times when trading is a lower risk and you'll have a higher probability of success, and these are the kind of times you should be active as a professional trader. Okay, so the next question is when not to trade. This is the opposite rationale to when considering the best times to trade, and we should be thinking about times that actually reduce our chances of making a profit. Of course, market analysis, engaging sentiment will be incorporated into your main trading, and by the end of your program, you will be well versed in how to spot these conditions, both good and bad. But the goal here is to give you the grounding so that you understand the importance of identifying these items in the first place and how this fits into your risk management plan. So an example of when not to trade, or a time that will actually create inappropriate risk, is during times when there is little or reduced liquidity. The more severe the lack of liquidity, the higher the risk, and the more urgent it is that you avoid the market. Severe liquidity shortages result in major slippage, stops not getting filled, and larger losses than originally planned, which of course goes directly against the risk management framework that we've already looked at. Liquidity tends to be short towards the end of a major session, going into the weekend, or when extreme black swan events take place and flush out most market participants. Of course, black swan events can't be predicted, but many traders are tempted to trade the aftermath of these events, which can be just as dangerous, as the liquidity can sometimes take days or weeks to fully return after these events have happened. Now, during these times, as just mentioned, the chances of losses happening are larger, but crucially, the chances of larger than anticipated losses occurring increases, which unnecessarily increases our variable costs. As part of our risk management structure, the next question is how we will enter and exit our trades. Now, this directly impacts our risk management structure because entering at market manually is generally considered to be the safest method of entering, while having a fixed order so that you get taken out automatically in the event of the market moving against you is generally considered safest for exits. So manual entry, automated exits. The reason for this is so that you can check and double check market conditions before executing a trade manually, ensuring that you have all the available information at hand and assessing your conviction levels in that moment. The alternative, of course, is having an order in the market to enter you when the price reaches it. But this does not factor in changes to market conditions, which may otherwise stop you from trading or lower your conviction levels. Entering the market at a time when the odds of your trade winning have evaporated is a controllable variable, and entries should definitely be considered carefully from a risk management perspective. Again, there are many other scenarios associating entries with risk management, but this hopefully helps you understand the underlying concept. Exits work in the same way. If your exits were not automated, then you leave yourself exposed to the possibility of the trade running against you further than your plan dictates during times when you're not actively at your desk or trading the markets. The final question to answer, of course, is how much you will risk on each trade. This is probably the most important thing to get right because it will most directly influence the entire outcome of your business above all else. Most professionals trade under normal circumstances with no leverage. Let that sink in for a moment. Most professionals do not use leverage when they are trading the markets on a daily basis. This does not mean that you can't ever use leverage, just that when you do, you must be very carefully thought through and planned with precision. Only the absolute highest probability trades with the utmost conviction levels should even be considered for the use of leverage. Because traders that consistently use leverage regularly without this type of planning eventually lose their accounts and with it, their entire business. Remember, the goal of this section and the entire program, in fact, is to get you thinking about trading as a business. Now, if you have a business, would you feel confident betting your entire future, borrowing lots of money from the bank to expand your operations if you only had a single client? Probably not. Trading is the same. Every stage has to be planned and thought through. And risk management is an area that gets a lot of attention in the institutional world, but almost nothing in the retail world. When you come across retail traders, you will notice that their main focus tends to be on systems or indicators and charts, with almost no attention paid to psychology or risk management, which in fact are the two biggest areas that need attention. And this is the reason that most of these uneducated traders fail and lose money, because they are simply not learning and focusing on the correct concepts in the first place. Okay, so how can we get a basic understanding of trading unleveraged? Well, obviously, we'll go into this in greater detail during the main program, but a very good way of explaining it as an introduction is to come back to some of the concepts you've already learned about in the Institutional Fundamentals course that we're going through right now, namely lot size versus account size. So, the simplest way of understanding how leverage works is by starting with how much money you have in your account. So, let's say for example you have $100,000 in your account. The standard contract size in FX is 100,000 units. So, very roughly, if you buy one standard contract using your $100,000 account, then you are not trading with any leverage because the amount you are buying matches the balance of your account. If you bought two contracts or 200,000 units, then you would be leveraged at 2 to 1 because you are buying twice the amount of currency that you have in your account. So the more contracts you trade in relation to the size of your account dictates how leveraged you are at any given time. This is worth considering when you're trading multiple currency pairs, because even if you only buy one standard contract on your first trade, if you add a position on a new currency pair, then you are now leveraged 2 to 1 and so on. It's also worth considering how much overall exposure you have to one specific currency, even if you're trading different pairs for different reasons. If you're inadvertently over-leveraged on one currency, and then something happens specifically to impact that currency and move it against you, then you will end up with magnified losses from your overexposure to that currency. So, as a general rule, we'll be trading with no leverage, meaning that on any position we open, we only trade an amount of contracts or lots relative to the amount of money in the account. This means that if you have 100,000 in your account, you will open no more than one standard lot. If you only have 10,000 in your account, you will reduce the size of your trades by 10 to 0.1 of a standard lot, which is also called a mini lot, and so on. This will help you control your losses, but it also ties in very nicely with the other pillars, which you will learn in more detail as you cover all the material in the main program. So, we've given you some very important points to consider when creating your risk management structure, and also not just risk management, but also your overall trading plan. We've touched on how risk management is also linked to the trading psychology element of the 4 pillars, which we'll look at next, because the more you risk, the more this influences your emotions and thus your overall decision-making process. What we haven't looked at is how the concept of risk management ties into the other 2 pillars, namely fundamental and technical analysis. Well, the truth is that it ties in extremely well, and this is why we call these things the 4 pillars, because they're all equally important, extremely interrelated, and form the basis of your entire trading career as a whole rather than on their own. So let's conclude this section by looking at this in more detail. So, you may have already been aware that risk management was all about controlling your losses via how much you risk on each trade, but what you may not consider is how your actual training and skill is a form of risk management too. To explain this further, we'll use the illustration that it's pretty easy for most people to relate to. The illustration we're going to look at is that of a rock climber. Now, imagine the rock climber that has 20 years of experience. They've climbed all the biggest summits, they've travelled the world, taken on bigger and better challenges. They have all the professional training required, they undertake these feats, and along with that they have all the best equipment, okay, which is maintained, updated regularly, everything's second to none. Now imagine the second person. This person really wants to be a rock climber, but instead of spending all their time training and learning the correct principles of rock climbing, they're constantly trying to shortcut the process in a way that allows them to climb with our professional rock climber right away on a big cliff face. They've read a few books, they've bought some second-hand equipment that they don't really know how to use, and they've almost no safety procedures in place whatsoever. Now, imagine I told you that one of these climbers was going to make it to the summit with no real problems, but the other one would fall and seriously injure themselves. Now imagine that I asked you to place a bet with your own money on which of the climbers you think will be the one to fall and injure themselves. I think most of the money would be on the amateur to be the one falling off that cliff. But why? Some people might argue, if they did not know the background of each climber, that out of two climbers climbing the exact same conditions, it's surely a 50-50 which one falls. But we know this is not the case, simply because one climber has a host of correct training experience, while the other one has almost no appropriate training and only limited experience. This fact makes it less risky for the pro and more risky for the amateur. And the same is true in trading. If you have the correct skills, training and experience, the risks to you and your business are vastly reduced. And conversely, if you have no proper training and very little experience, your chances of succeeding are virtually nil. So the point I'm making here is that your training and knowledge and practice in this professional environment is a form of risk management, because the better these skills become, the greater your chances of success become, and the harder it is to lose your money and your business when you implement all of these things that you've learned. This also sums up very well why most new traders with ambitions of learning from home fail. They never really had a chance in the first place. So remember, to create your risk management structure, and as you learn more of the techniques and procedures through the program, focus on the importance of implementing them so that you always remain fully in control of your costs, incomes, and risks.